Hi, this is Patrick Henry, the CEO of QuestFusion with the Real Deal What Matters Live. I'm here today with my good friend, Mark Steele. Mark is an expert on business development and developing strategic partnerships, which I think is an extremely important topic for entrepreneurs. In Mark's current practice, he works with CEOs on helping them to accelerate their sales growth and build partnerships with the right ecosystem partners. So a little bit about Mark's background. He's been a general manager and head of sales and business development for a number of notable brand companies, including Motorola, Gateway Computer, IBM, Qualcomm, and Monster, which was formerly Monster Cable. He is a former chairman of ComNexus, which is a nonprofit that focuses on telecommunications industry. And he's an experienced board of directors member and is currently on the board of a great little company called Urban Translation. So welcome, Mark.
Thank you, Patrick. Nice to see you.
Yeah, good to see you again, too. It's been a while. Mark moved out to the East Coast about 3 years ago, so he's enjoying the Carolina weather.
Yes, we have weather here.
So today we're going to be talking about strategic partnerships, obviously an area near and dear to both of our hearts because we've driven a lot of business success based on the partnerships we built at a number of different companies. Talk to me a little bit about your definition of what a strategic partnership is and how that's different than a customer relationship.
Yeah, if you think of a pyramid and think about the apex of the pyramid being an acquisition. And if you think about the base of the pyramid, the lowest level of the pyramid being some sort of transactional relationship that doesn't have any long-term contract or long-term value, doesn't have any real long-term relationship. It's just a transactional relationship. Everything in between is a different kind of partnership, and there's many layers.
Mm-hmm. Yeah, I mean, it's interesting. So can you talk a little bit about, from your perspective, the different types of partnerships?
Mm-hmm. Mm-hmm. Sure. So if you come up off that base layer, which I don't define as a strategic partnership, it's more transactional, then you might just have something as simple as a long-term supply agreement or a long-term customer agreement. And that is a partnership, but most people don't think of that as strategic because it's an everyday thing. And then above that, you might have, let's say you had a 5-year supply agreement with someone that was absolutely critical to your future, and you wanted to have certain terms in there that would enable you to continue to get supply from them, even if they were to have financial problems, for example. Well, then that requires a really sophisticated set of terms and conditions and a contract that protects you. And so that would be probably the lowest level of strategic partnership, which is something that's long-lived, has strategic value to one or both of the parties.
So how did you become kind of an expert in this area? Like give me a little bit about, how you've kind of navigated through this for the CEOs and entrepreneurs out there, and let's say you want to pursue somebody. It's kind of like two teenagers dating, and they don't necessarily know what to do. So nothing ever happens.
Yeah, well, that's true. So I think it probably is helpful to set a context that when I first started to be really focused on partnerships and making them work was when I was at IBM 20 some years ago. And I watched how IBM tended to really, to be honest, abuse their small startup innovative partners. And it just bothered me. And so I tried, when I then left IBM and went to my first startup, I really worked hard at making sure that our partnerships were more balanced. And of course, you're going to want to know, well, how do you do that if you're a small startup when you're working with a mega brand? But that is possible. And then later, having been in several startups and been advising startups as a mentor or as a board member for 20 years, that I really started to become acutely aware of how the small businesses are really essential to the large businesses, even if the large businesses don't admit that.
Yeah, for sure. I mean, it's interesting because especially with public companies, there's so much pressure on short-term earnings performance that you really need to do a lot of the more high-risk innovation, what I call off-balance sheet, which is using, partners that are smaller, more risk-oriented startup companies.
Yeah, there's a lot of research that's been done in the last 10 years that shows that the larger a company becomes, and frankly, the more successful they become, the harder and harder it becomes to internally innovate. We could probably have another session just on that. Yeah. But that's, you don't have to take my word for it. You can go look at any number of research papers that have been written on this subject. And so larger companies that are sophisticated and want to keep that innovation pipeline going have specific strategic partnership programs that are not just on the supply side. They're not just on the sales or go to market or route to market side. They're really strategic. They're thinking about, where are we going as a company? Where do we have to innovate? Do we actually have the ability to innovate in that area? Or if we do have the ability, do we have the people? Do we have the right IP? So that kind of sets the stage for why large companies are strategically partnering with smaller companies. And it's primarily centered around innovation at a lower capital cost. You just mentioned that, at a lower risk, off balance sheet, as you said, up into if and when it ever became an acquisition. And tying these together in sort of a sequence where it might lead to an acquisition is actually really powerful. Hopefully we'll have time to revisit that thought.
Yeah. So how do you identify the right person kind of in a target partner company that has the influence to make decisions around entering into some more formalized arrangement, all the way up to making an investment and possibly even M&A over time?
Yeah. So that's a great question, because it is so much material that's out there for free. A lot of people jump to hiring someone to go figure that out and point them to a partner. And a lot of times those are business brokers, or sometimes they're purely commission only B&D people. I don't like to work with those people, because you're paying for something that frankly is in the public domain. So let me just give you 2 or 3 examples. So if I'm advising a startup, let's say pro bono, I just tell them, here's 2 or 3 things you can go do for free. It's going to take you some time. And if I'm advising a company that's paying me as a partnership consultant, then I'll of course tell them, you could do this yourself, or you could pay me to do this. It's really just a make or buy decision. So here's the things. The first thing you do is you go out to, if you have somebody already in mind, and if you don't, let's revisit that maybe in a minute. But if you have someone in mind, first go to their website and search for their partnership page. That's key. If they have a partnership page, it tells you that they believe in partnerships, they see value in it, they're willing to dedicate some real estate on their website to it, and then start diving down, seeing who are they? What are they on the supply side or on the go-to-market side? Are they some other kind of partner? Are they technology partners, IP partners? Let's take a look at those, and then kind of do your homework and read those. Second, go look at the press releases for all of those companies, the host company, let's call it the one that would like to be partnering with you maybe, and look at their press releases over the last 2 years. And it's not hard to download those or search those, and just look for some keywords like partnership or sales or supply or anything like that. And you'll find them very quickly. Or if you found 2 or 3 or half a dozen partners on their webpage, go look at their press releases. And now you've got all this free material. Then finally, if you're really looking for an innovation partnership, maybe go spend a couple of hours on the US Patent Office and look for some patent filings that are originating from either the host company or the partners. Now you'll get an idea, are they really trying to partner because of some patent portfolio or not? And that's probably where I'll leave it right there. There are some things that are all free, just take some time. Probably for each partner you're going to investigate, you could probably spend 2 to 4 to 8 hours if you wanted for each of for that sum total of what I just told you.
Okay, terrific. So through kind of various elements of my career, not only, running companies, but also when I was, head of marketing or general manager, we were to be able to build a number of different strategic partnerships kind of across the whole supply chain. Meaning that, we had people that were suppliers that were interested and potential customers and customers, as well as other kind of ecosystem partners. How do you kind of make the decisions around what are the highest priority and what kind of relationships you want to build with those types of companies?
That's a great question, because it brings up one of the key aspects of the methodology I use to explore this. Think of a value chain. We've all been using value chains for our entire careers. Now, make it 2-dimensional and consider it a value grid. Put yourself in the center. and put the end users of your product or service or technology at the far right. So now you've got the beginnings of, let's call it a chessboard. And the people that are going to truly receive the value of what you have in some form, maybe in combination with your partners, are at that far right. Then start working backwards. And the simple question, and it's a little bit simplistic, but you'll get the drift of this. If you ask, where do those end users get that technology? It might be internally from some other department in their company. It might be from a buyer. It might be from some kind of sales organization in another company. Then say, where did they get that? And then you work backwards. Then you do that for yourself first. Then look at your competitors and do it again and put it all in the same chart. Then finally start saying, well, wait a minute, let's think outside the box for a minute. Where do your end users and their buyers or suppliers, where do they get technology or IP or services that they already combine with theirs to deliver more complex and more valuable solutions? That will open up this grid. And now you'll be populating dozens of cells in this grid and this is just a brainstorming tool, Patrick. This is not, you're not going to go talk to every one of these parties. What you're doing is brainstorming. And then to keep it simple, after you've done this, and I usually do this in a brainstorming session that lasts a couple of hours with maybe a half a dozen key people from a client company or a startup. And when we're done with a 2-hour session of brainstorming, what we have is, aha, look, right here in this grid, I've got this entity that is supplying and receiving, and they're kind of in a hot spot, if you know what I mean. And you and I both came out of the telecommunications space. If you think about a telecom network hotspot, a node that's very active, that's what you're looking for. When you find those, you're only going to find a couple. You'll find 2 or 3 in each market segment. And those are your potential partners. So if you didn't come into this exercise already thinking of partnering with company X, this brainstorming exercise will give you two or three to think of. If you already thought of one, put them on this chart. And then do a couple more and really think outside the box. Where are the potential partners? And here's why. Some of those potential partners may not even be thinking about partnering. And that'll lead to something we can talk about hopefully in a minute, which is how do you get them to answer your call?
Yeah, well, let's jump right into that.
Okay. So you remember we talked about the research, all that free stuff. Yes, it's 4 to 8 hours of invested time, but you can do it. And now when you make that first call or email to that target company that you're thinking of partnering with, this is the most important thing. Don't make it all about you. Most people make it all about them and they get on the phone. They're finally thrilled to be talking to a live human and not voicemail. And guess what? They talk about themselves and their product. And that is not what you want to do. What you want to do is, based on your research, is say to whoever's picking up that call on the other end, hopefully a professional product manager or business development manager or an executive. What you want to start with is, here's the value I bring to you in your pursuit of additional markets, additional customers, additional revenue, same things you're looking for, they're looking for. So if you start the conversation with, here's how I bring value to you, that means you really have to be informed about what do they care about? What is their strategy? Where are their problems? Where are they successful? Where are they not successful? Where are they trying to go? And you can infer all that from doing just a little bit of research. Then you get onto that conversation. And if you start with the value, now that'll bring questions. And the person you're talking to, if they're a professional, if they're really serious about partnerships, they'll start probing you for questions about, well, how do you help me get additional revenue? How do you help me penetrate an additional geography? And now you can start talking about you and your company and your products and how they fit in. Be prepared to ask them a question or two, only a couple, about how, once you've told them a little bit, to say, how do you think I could fit into your route to market? How do you think I could fit into your supply chain? Or if you're not sure, say, who else are you partnering with that is similar to me? What kind of a relationship do you have? And so you want to only, probably on that first call, you probably only get a chance to ask 1 or 2 of those questions, but that'll really be valuable for you to then prepare for the next call or the meeting, the face-to-face meeting, which is your real objective.
Yeah, I think that gets to a really important point. I think a lot of times and I'm not saying this about every entrepreneur and every startup CEO, they really want to close the deal on the first call. And it's a process. It's kind of like the same thing as a process for raising outside capital. You know, you've got, what is the executive summary for? To get a meeting. What is the first meeting for? To get a second meeting. So it's really building that relationship and kind of tying it back to the value chain. The value chain is so important for identifying the players that exist along that chain, but also the value aspect of it. So can you talk a little bit about that? You know, how you identify that the value for a particular target?
Yep. So that's great. I really love your analogy there. I have used that same process in sales and business development, in interviewing people, and raising money. As you said, you really have to think, what is my objective for this call, this meeting, this email? A lot of people send out emails and don't really think, what is my objective of this email? If you do that, then it'll force you to answer that question you just asked. What is my value to them? And if you spend most of your time, probably 60 or 70% of your time, thinking, what is my value to them? Then you have to do the same kind of thinking and research that we do when we're doing a sales call, which is, what is the customer's problem? What is the customer's strategy? Where are their problems? Where can you solve their problems? If you think like a salesman, only double it. You have to think about, not only am I, quote, selling myself and my product to this company that I want to partner with, I'm actually turning it around and helping them see why I should partner with them and they should partner with me. So it all comes down to value. And the only way to figure out value, because as you pointed out, the value could be an innovative product. It could be an innovative service that goes with their product. It could be some IP that enhances their product. It could be customers. I have customers in a segment, they don't. And we're not competing, but I can now pull their products into my customers. That's called a route to market partnership, or vice versa. They have customers I don't have. Now they're part of my route to market. Now I can supply my products to them. And so by doing your research and by formulating just a couple of really important questions, then as you start to peel this onion back, you'll understand, how is it that I add value to not only the target, the partner I want to have, but also their customers. And if you can't put that down on paper, then please don't pick up the phone. Please don't send that email. Please don't go to that meeting. You've got to have at least 2 or 3 things that you know how you can help that company grow faster, lower their cost, shorten the time to market, or penetrate new markets geographically or market segment wise. If you can't do one or more of those 5 things, then you're wasting their time.
Yeah, for sure. I mean, it's the whole concept of being mission and objective driven and having clarity around that, because otherwise you can't even measure if you've been successful or not.
Exactly. And thank you, because one of the other things that I try to do as a consultant, but I also try to advise startups, is don't let that partnership be the end. That's the beginning. And all of those things we just talked about, Patrick, have to result in a partner management process to make sure you're getting the value you want and they're getting the value they want. And there better be a contract behind this. And the terms in that contract better reflect the value that you're adding and they're adding, right? Otherwise, you just had a whole lot of preparation and research for nothing.
Yeah. So put your hat on as a board member, and when you're being approached, by your CEO about, hey, I want to really pursue this partnership, what are the things that you really look for in the questions you ask in that context?
Well, conveniently, I'm on the board of Urban Translations, which you mentioned, which is a really innovative startup in the hospitality space. But I'm also on the board of Hunter Industries, which is a 40-plus-year-old company in the irrigation space and now in lighting space. And they are up in the multi-$100 million private company. And so when I'm talking to startups or small companies, here's the counterintuitive thing. A lot of them are really afraid of being trampled. They're afraid of being abused by this big partner. They've heard bad stories about how Microsoft is going to take their IP, or how Verizon is going to swallow them up and spit them out, or Walmart, which is famous for destroying their partners by driving the price down so low that they can't stay in business. So a lot of startups begin this whole conversation, Patrick, with fear. Partnering with that company, it scares me. Well, good to have a little fear. But if you do the work we've just talked about and you really think about the value that you bring to them, you shouldn't have any fear. And I'm sure you've run into this with fundraising, Patrick, is a lot of startups, they're afraid that they come on bended knee to the person with the check and please, please, please. But really, they ought to be thinking, what value do I bring to this investor? Well, same with a partner. You want to bring value and be confident about your value. And then this is the most important thing for those out there that are listening that are in small companies. You need to leverage the assets of the big company. It will take you $100 million to establish that brand name. It'll take you 1,000 salespeople feet on the street nationally to penetrate that market you're trying to get. You can't afford the money, the capital, the time to do that. And why would you reinvent the wheel? If there's a partner out there that has those assets and that you can convince will get value from you, and you already know the value from them, it's their sales force, for example, or it's their existing customer base, then all it is just, like I said earlier, kind of a very sophisticated sales process is to make them understand how you bring value to them, but don't go into it with fear. If you're afraid, then don't go into it with fear. And the second most common objection that I run into is, again, this is probably not with startups, it's more with mid-sized companies, is, I tried to partner in the past and I didn't like having to split margins. And so when I hear that, I say, well, tell me about the margin splitting. And they'll go through it. And I'll say, well, it sounds like you didn't do a formula to really assess what is the value you bring to that partner and what they bring to you so that you could establish the margin split that would work for both of you. And that's when their eyes usually go, because they went into some sort of channel relationship. They split too much margin, or they split the right amount of margin, but didn't ask for the right value. Mm-hmm. So it all comes down to value. What am I paying for the value? Is it a transaction that makes sense for both parties? If it does, then it can be long-lived. Then it can be strategic.
Yeah, it's really interesting. That's a very common question that I get with a number of companies I advise is as they're building out their sales force and their channel partnerships, the difference between, a manufacturer's rep versus a stocking distributor versus a value-added reseller. And I like how you really boiled it down there, that it's all about the value they provide. And, you need to make those trade-offs and negotiate from a position of strength, saying, hey, I'm going to add a lot of value to you as well. Yeah, maybe you get a smaller percentage than you're asking for, but the overall dollar amounts can be massive.
Right. So, let's talk about a really simple example that people really screw up. Referrals. How many times have you heard about, I'm going to refer customers to you, but I want 20%. I have a simple little formula. We don't have to go into it here, but it starts with 5% for a couple of actions, and it doesn't involve a business card. It's introducing me to someone in person or on a phone. That's 5%. Then 10% for a little more, 15% for even more. 20% might be, you're going to be with me all the way through the sales process. You're not selling. I'm not paying you a commission. I'm selling, but I need to be able to call you, Patrick, at every stage of the sales process. And if I hit an obstacle, I want to call you and you're going to help me figure out how to overcome those obstacles. The bid is mine. The sale is mine, but I will pay you 20% for really being my wingman right through it. And why would I pay you 20%? Because you know that customer. You've been supplying him for 20 years or 10 years. You know his ins and outs. You know how he likes to buy. So referrals are just one kind of partnership. And I see it messed up so often. Usually people offering too much for too little.
Absolutely. That's a great insight. So any kind of closing remarks on this topic?
I think we talked about preparation, and that's key. That's one of my pet peeves. Prepare, prepare, prepare. Use this value grid that I think of a value chain, but now make it two-dimensional. And then if you've done all that and you really love the result, do it again for another market segment, maybe an adjacent market segment, and then do it a third time. And then stack those up where you have 2 or 3 of these two-dimensional value grids. And now you've got a little nice Rubik's Cube. And when you stare at that Rubik's Cube, you'll really see the hot spots. You'll see where the activity is. You'll see who is adding value. We talked about leveraging the assets of big, and for big companies to really use a small for innovation. And that's kind of my formula. That's how I approach it. And I think if your listeners will really think about those elements, and if they will go out there and just do the research and do the preparatory work before they make that first cold call, then I think they will raise their odds of success and they'll have a much more valuable partnership.
Awesome. Those are great tips. I really appreciate it. And hopefully the entrepreneurial audience out there appreciates these insights as well. I think this is a lot of stuff. It's, you know, what I call where the rubber hits the road. Right. You know, a lot of times we want to talk about some of the bigger strategic things, but this is the difference between making money, driving revenue growth, and kind of just stalling and, you know, puttering along and not really getting things off the ground. So this is fantastic.
Totally agree. And for those of you that are listening, if you feel like you've stalled out, if you feel like I need something to get my revenue back or get my innovation back, then just go back and listen to this again. And there's your formula. That's how to approach it.
Fantastic. All right. Terrific. Thank you, Mark. Appreciate it so much. And maybe we'll get on again and talk about innovation in big companies versus small companies. I think that's a great topic as well.
I'd love
to. Thanks a lot, buddy. You take care.
Bye-bye.